Hi everyone and welcome to Class 8 Personal Finance. This video is for folks who've already figured out an asset allocation, such as this one. I have an example one where I have 80% stocks, 20% bonds, and I've split those out into different categories, including 60% US and 40% international. Now, this is sort of nice and clean, and even if you have three different accounts, maybe it could look something like this. You have 48% in US stocks, which is 60% when you split it out as 80%. So 80% times 60% is 48%. That's how we get that. And then you have 32% in foreign stocks and 20% in US bonds. Now, these numbers are obviously fudged because the real world isn't like this, where you have these nice, perfect numbers. Instead, it might look something more like this. And you have this old 401k that you had at the previous employer and you weren't paying much attention to it over the past 5 years, but you're trying to get going again. And it's like, okay, how are we going to figure this out? It's best to look at the portfolio as a whole. I mean, you could, do something like this, like make it very organized and you have the same percentages across all of the accounts. And if you have accounts that all get the same tax treatment, then reasonably you could do this. In the real world, maybe not so much, unless you start talking about Roth conversions or something, and that's a whole other video. So how do you work it out in a context like this? So first, I'm going to show you how I built this spreadsheet, because a spreadsheet is an essential tool to figuring out how you reconcile these accounts and get some things in order. And the second thing we're going to do is talk about tax efficiency, because we have stocks versus bonds here, and we have tax deferred versus tax free. So here in this example, I have three accounts. I have an old 401k. By the way, this is hypothetical. This is not my particular situation, but it's close. An old 401k that's tax deferred. So taking the tax deduction beforehand, it's kind of the old way of doing things, and then being taxed on the way out. Then we have two Roth type accounts that are tax-free, a new 401k and a Roth IRA. Old 401k being from a previous employer, so the one that was kind of ignored, and it's like, maybe I should go back and see what's going on over there, kind of thing. So I have a spreadsheet here where we have plugged in these numbers. These numbers right here and these numbers in bold are auto-generated, and the easy way to do that is just with a sum formula. If you're not familiar with spreadsheets, equals sum, and then the range is how you would do that, B3 through D3. Now, I'll have this spreadsheet in the description of this video if you just want to copy mine, but you do need to understand what's going on here so that you can work this out for yourself and have something that you construct. So B3 through D3 for that sum, B4 through D4, B5 through D5 for this one. And that's easy enough if you're constructing it yourself when you just drag like so. This right here, it's the sum of these three, E3 through E5, and so on. Percentages, easy enough because you have your numerator being the sum total of this row right here, and you're dividing by the overall amount of the portfolio. The little trick here is that you have to have this dollar sign before the E and before the 8 here, so that the numerator doesn't change when you drag this down. If you were to drag this down like this, and you didn't have that conditional there, then it would declare your denominator to be E9 and E10, which are both 0, and those aren't numbers when you divide like that. The target percentages, that's based upon the asset allocation that you choose. And the delta here is this percentage minus this percentage, so the current percentage minus the target percentage, divided by the overall amount of the portfolio. And what this gives you is the amount that you need to transfer from one asset class to another, so that you don't have to rebalance all three portfolios. You could, in theory, rebalance just one or two in this case because I made the numbers so different. So let's say that we want to rebalance this portfolio back to the target percentages. The first thing we could do is take this percentage of US bonds here with this portion, and we're just going to transfer this money over. So we would say within the new 401k, we want to move 1,985 into, let's just say, US stocks, because the US stocks are lagging the most. So just remember that number, 1,985. We can come up here and we can just have it do the math for us. 1,086 plus 1,985, which equals this new number. The old account balance is still the same there. We're just moving money inside the account, and now we're a little closer. Now we're at 42 when we're trying to get to 48. Now, in U.S. bonds, we need to transfer $3,517.80. So let's remember that number. Better yet, I'm just going to scratch paper it, sort of. 3,517.80, because that number is going to disappear once I turn that other number to 0. So let's do that. In fact, let's go, let me just go ahead and transfer 3,555, and I'll show you why in a moment. So 3,555, we're going to transfer, and we're going to transfer it also into US stocks. And you're kind of going, whoa, we're kind of going over here, but I'll show you why. 3,555 right here. Okay, so $12,187 now in US stocks, and now we've cleared out the US bond allocation. I'm going to put a 0 here just so we have that dash there to keep the format consistent. Now, we have a surplus. We have $1,170.32 in here. We need to transfer that over. So, yeah, okay. 3,555 minus 1,170.32. I'm going to reduce that amount. I think I got overzealous. But see, that's sometimes what you got to do when you're dealing with these spreadsheets. So I'm just going to calculate that out here. 3,555 minus 1,170.32, which is 2384.68. So I'm going to put, let me scratch this out here, 1170 point, whoa, no, 0.32. Just going to work this out in my head. So I'm going to 6,003 here, and I'm just going to add that differential right there, 1170.32. And then we are going to reduce the amount that we add to US stocks, 2384.68. So now we're almost completely balanced. This is pretty nice. 3720 isn't even that much to worry about. But here's what I was also doing at the same time. What I was doing was clearing out all of the bonds from the tax-free accounts. Why would you want to do that? The reason you would want to do that is because we expect bonds to grow more slowly than stocks over long periods of time. Now, we have the bonds there for safety, and we usually increase the bonds over time so that when we get closer to retirement, our nest egg is more secure. But why would you want just that slower bond allocation in the tax-deferred side? Because we expect the tax-deferred side to be taxed. That's what tax-deferred means. So would you rather have more money taxed or less money taxed at the end? It's better to have less money taxed and therefore to have this more of the slower assets in the tax-deferred side to the best extent that we can. So as long as you're talking about just tax-free and tax-deferred accounts and you're not adding a taxable situation into here, then the simple advice, or rather the simple recommendation, I can't say it's financial advice, this is not advice, right, is to have your bonds in the tax-deferred side. A little note about financial advice. I'm not a financial advisor. I'm not your financial advisor. So you need to figure out something that works for you. I'm stating principles and educational stuff because this is about educating investors. That's what I want to do here. So you keep this bond side within the tax deferred, and that's going to give you some tax efficiency. And then you have a spreadsheet like this, and you can have a total picture of what your portfolio is doing, and you don't necessarily have to worry about whether you have 48, 32, 20 in each of these accounts. When it comes time to rebalance, you may only have to rebalance one of them. You may only have to rebalance the tax deferred side because you have just stocks here. Or if you're contributing to the Roth IRA, the new 401k with new money, you could be adding some bonds here during that time because you want to keep things in balance. Or you could say, hey, I'm just going to rebalance the bonds once a year or something like that. Find something that works for you, but hopefully this is a tool that might come in handy for you and a strategy that might come in handy for you as long as you work out something that's going to work best in your circumstances. And so everybody's circumstances are different. Find something that works for you. If you liked this video, like, share, and subscribe. And thank you for watching.